Hey everyone, welcome to another edition of Strategic Financial Management. In today's class, we shall be looking at merger and acquisition. Either you merge or you acquire the business called takeover, right? At the end of this topic, you should be able to have an understanding of merger or acquisition. Alternative to acquisition, reasons for merger or acquisition, disadvantages of acquisition, merger or acquisition, the reasons why acquisition fail. Then we should be able to as well look at what we call synergy. Synergy will take us to due diligence. Due diligence will take us to the regulatory framework of merger or acquisition. Now, what is merger? Now, don't forget that merger or acquisition is a form of valuation of a business. When you want to merge, you do a valuation of that business. When you want to take over another business, you do a valuation of that business. Now, you should as well know that in merger and acquisition, there is what we call acquiring company and target company. You could say acquiring company or acquired company. What is acquiring company? Acquiring company is a company that want to take over a particular company or that want to merge. Then the other company called target company or acquired company. Isaiah Nigeria Limited produces cement. Olanike Nigeria Limited produces sugar. Isaiah want to merge with Olanike because there is kind of a competitive advantage, right? There's kind of a competitive advantage, right? Isaiah want to merge with Olanike, right? Who is the acquiring company and who is the target company? Isaiah want to merge. Isaiah is a target company, while Olanike, that is producing sugar, right, is acquiring company, right? And that is the acquiring and a target company. So in merger and acquisition, we will always have a target company that you want to take over, which is the acquired company, and the acquiring company, the company that want to take over or that want to merge with other business, right? Now, what is merger? Merger means amalgamation, right? You merge with other business in order to get some other what benefits. That is merger. Then acquisition. Another name for acquisition is called takeover. Acquisition means you buy everything. You did not want to merge, but you want to buy everything, right? 100%. A practical illustration right? Could be in a case of Profidos Bank and Unity Bank, right? We don't know we don't know whether Profidos want to merge with Unity or Unity want to merge with. So we don't actually know, right? Because recently I saw that CBN actually approved their merger, right? And we see some oil companies as well buy over another business, another same oil companies, right? Those operating in upstream, right? Acquisition, 100%. And that is what merger. Merger, you merge with other business to gain a competitive advantage. While acquisition, you acquire the business 100%, right? Now, what is alternative to acquisition? That is alternative to take over. If I don't want to take over this business, I could say, let me think of alternative, right? And what is this alternative? You could say, oh, growth through internal development of the business, probably an expansion. You could say, oh, I don't want to, you don't want to actually acquire this business. You don't want to take over. Instead of me taking over this business, we will get there. Instead of me taking over this business, I should just do what we call internal development. That is an expansion. You can pursue an expansion strategy, right? You could say, instead of you merging with buying over this company, you could say you could do what we call joint venture, right? You could do that because of you want to expand the business. You don't want to take over 100%. Probably your risk management officers have actually advised, no, we don't want to take over. Let's just do what we call internal development. That is why you will see some other organizations, other businesses, if they want to expand, right? If they want to expand, if they look at it that okay, we want to take over, AA Limited, and probably the acquisition did not work out due to one or two reasons. The next thing is that let's look for an alternative, which is expansion, or we do what we call joint venture. Now, having explained this, we will move to advantages. We could say, because mostly your questions under merger and acquisition is 50-50. And when I say 50-50, is 50 calculation and 50 theory. And that is why I need to explain so that when the available, when the available, when the desirable is not when the available is not when the desirable is not available, the available becomes the desirable, right? So that you can use your own initiative. So that you can use your own what initiative. Now, having explained this, there is advantages of acquisition. Another name for acquisition is takeover. Is takeover. You buy over, you take over the business. And mergers. Now, this could be also be a purpose of acquisition, because question may tell you that what are the advantages of acquisition or merger, or what are the reasons for acquisition and mergers, right? Or what are the purpose, right? say what are the purpose. We've been talking about this purpose, right? One of it is that when you go through acquisition or merger, it's much faster than growth through internal development. When you do what? When there will be a growth in the business when you go through what? Acquisition or merger. Now, it will give you more competitive advantage. That is another one. You gain the market. You have advantages over other similar company, right? An acquisition can give the buyer immediate ownership of new products, right? That is the market. New market and new customer that would difficult to obtain through internal development. You can see, if you want to do an expansion will not give you new customer, may not give you new customer. But when you merge my own customer and the other person's customer, when they comes together, they will improve the revenue of the business. So anything that internal development cannot give you, acquisition or merger can do that for you, right? Acquisition or merger can actually do that, right? Now, an acquisition enables an entity to enter new markets where the barriers entry are high, so that it will be very difficult to set up a new business in competitors, right? When you are going, when you acquire business, there are some entry. When you want to enter, there are some businesses. If you want to enter into that particular business, you need to meet up with a particular capital base, like insurance company now. Before you can say you want to set up an insurance company, you need to meet up with a minimum capital base. Like a financial institution, if you want to say you want to do a financial institution in Nigeria, you need to have a minimum capital what? Capital base. So it makes it easy to enter into that what? New markets that is barrier, right? That is barrier. And again, if you enter into the market that is barrier, it will be very difficult for new setup to compete into the business, right? So that is why what internal development cannot give you, acquisition and mergers can actually do that, right? Don't forget all this. When purpose or reasons is for fast growth, because internal development, expansion, joint venture may not give you fast growth, but when you merge, it could give you that, right? Competitive advantage. You have more advantages in the market. Now, it makes it makes the entity to enter into a new market that has actually has a what? High barriers. That is, before you enter that market, you have to meet up with it. But when you acquire that business, you have enough capital base. With that, you can go into the what? Into the market, which setup can never do that, right? It will not happen like that. Another advantages or reasons for acquisition and mergers could be to reduce cost. See, you need to be smarter. We are all professionals, right? Now, these cost savings and high profit, I can decide to separate them and say, oh, if that would be the case, to reduce cost. One, I will now the next one will now be okay to increase revenue, which is profit. Is that also? So you give you give decrease in cost and increase in what? In profit. You have points, one point. Just put small explanation and you move on. Because they will ask you, right? Now, an acquisition prevents a competitors from making the acquisition instead. Now, another thing that the reasons for acquisition or advantages of acquisition or merger is innovation, right? Or access to technology. I, for instance, now, Isaiah have access to some kind of technology that will be used to produce the cement. Olanike Nigeria Limited does not have that capacity. When we match together, it will give me some kind of advantages into what? Into technology, right? It brings innovations. It brings rooms for what? Innovations, ideas. So you could give them. I think it is usually maybe five, explain five. They can just tell you that explain five or six of them. So you should know the reason why there should be a merger or acquisition or advantages. What are the benefits over internal development? If you don't want to do alternative, that is alternative for acquisition. You don't want to do internal development, you don't want to do expansion, and you don't want to go into joint venture, right? You could you could merge, or you do what? You could merge, or you acquire another business, right? Now, like for instance, I've mentioned that practical, in the case of Providos, and in the case of Providos and Unity, we don't know which one now, whether Providos want to merge with Unity, or Unity want to merge with Providos. But guess what? In the merger and acquisition process, they need to look at it. Okay, what are the benefits? If at all Providos want to merge with Unity, for instance, what are the benefits? Could there be an increase, or a increase in revenue, or could there be that our customers will increase? Could that be that? So these are the things. What is the capital base? Who are those who use Providos and Unity? So these are the things that those guys who are in merger and acquisition process, these are the things that they will analyze. They will say, Oga, let Unity to come and merge with Providos, or Providos should. So it depends. I've not seen the document, and I'm just saying it. I'm just using it as an example, right? But what I saw is that CBN approved the merger of Unity and Provido. So we don't know either. I don't actually know if it is Provido that want to merge, or it is Unity that want to merge with what? Providos. Now, synergy. Now, what is the disadvantages of acquisition and mergers? Class, what is the disadvantages? One of the course I took from JP Morgan was on merger and acquisition, the process of merger and acquisition. It could be cumbersome, right? And kind of expensive. You talk, because when you value the business, let's say Isaiah now want to take over Olanike, right? Isaiah will go for a bid. We bring a bid. That is the first. You need to do what? There will be a bid. You bring a bid that, okay, this is it. But however, before you can bring this bid that this is the amount you want to use to acquire Olanike, Olanike should have given you access to what? To their financial account, probably the previous year as well as the current year, so that one will form part of your what? Part of your bid, because that is what you will use to value the business. If Olanike did not give you the information of their business, of their business, right? How will you arrive at a particular bid that you want to pay for the what? For the business? And that one will take us to what you call hostile what? Takeover. We'll get there, right? Now, one of the disadvantages is that it could be expensive, because so many people will be involved. Now, the bid price has to be high enough to make the shareholders of the target company willing to sell their shares, right? It could be what? It could be expensive. If I want to buy over, or if Isaiah want to merge now, it could be expensive. And the target company will be willing that, oh, Olanike will be willing that, oh, Isaiah is coming with 150 billion. Yes, that is expensive. Moreover, the business does not even worth that amount, class. It does not even worth. Maybe it is not even up to that up to that value. But the target company, which is Olanike, will be saying, okay, we expect Isaiah Nigeria Limited to come up with what? With high bid price. Right? The return on investment for the entity making the acquisition might therefore be very low. Can you see? The return on investment of Olanike that is expecting high bid price may be what? May be low. So acquisition might be what? Might be expensive. It may not worth it. It may not worth. It may not worth it. Right? Acquisition. Class, are we still together? No be say I dey speak to myself. I need to confirm. Oh, hope say no be AI.
Together, sir.
Okay, nice one, nice one, nice one. Okay, it's not AI.
AI don't attend class.
No. Oh God, nothing is impossible. Yeah. Umar Abubakar, any question? Maybe it's a mistake. Okay. A minute. I need to check. Okay, where are we? Acquisition. A merger or acquisition can result in a loss proportion ownership of the entity. Of course, it is because it will lead to dilution of shares. This will take us to IAS what? IAS 33 NSP shares. It will lead to what? Dilution. Okay, let's say Isaiah Nigeria Limited merge with what? Olanike, right? Now, you have ownership. There are existing shareholders. Is that not so? Those people who are there, they have a certain percentage. Because you are coming in, the percentage probably they gave me 5. Because you are coming in, it may reduce to 4. Because the shareholders now is more than what we have before. Right? It's more than. So is one of the disadvantage. Right? A merger and acquisition can a loss of proportion ownership of the entity, right? And that is why when there is kind of when Mr. A wants to merge with Mr. B, some maybe majority shareholders, right, may not want to take that particular, may not want to merge with the other business, even if there is an advantage. Do you know why? Because they will look at it that, okay, when they merge now, what will be their benefit on the long run? Their proportion, their ownership might decrease from 10% or from 20% to 1% or to 5%, right? Another disadvantage, please, hope we are picking it. Expensive, loss in proportion of ownership. The next thing is what? Organizational structure, different style. This may bring, it may be difficult. Bringing this, in the case of merger, you merge with B. I don't know. The organization structures of A is different from B. right? And that could lead to it may make the acquisition, it is one of the disadvantages of it, because it will be very difficult to bring these two structures together. Imagine, what are the kind of structure? This is not supposed to be the head of finance. You have a head of finance of this, you have a head of finance of this. So how will you now collide? How will you merge them together? How? So that could be what be very what that could what be difficult to what to achieve. Disadvantages, please take note of that. Organizational structure, right? Then don't forget that they have different salaries scheme system, right? Different what? Different salary what? So how will you do that? How do we now bring all together? Different system of salaries and wages, bringing them together into a single entity will be extremely difficult. Naturally, many employees will feel threatened, right? That is why when when that is why in organization that we are now, if I come in now and I said, oh, this thing is wrong, right? It's not supposed to be like this. Some will say it is right. Why? Because their resilience to change, they don't want to change because they know these disadvantages of change, right? They know these disadvantages of what? Of change, because they may feel threatened as a result of what? As a result of that what that as a result of that what is it called? Action. Now another thing is organizational culture. Different organization have their own culture, different different cultures. Bringing them together may probably bring clash of cultures, and it may be difficult for individuals from different culture to work together. It actually happens in our various work. You will see this tribe, this, right? Hmm. Even in that organization that is not merger, there is always back and forth. There is always little challenge. What if they now bring in, probably they're bringing in firm that is maybe an organization that is from the north. Then you have southwest. Ah, what of culture? The way they do there, probably they wear niqab, they wear hijab, they wear, so it's kind of difficult. There may be kind of clash. So I'm just bringing it so that we'll understand that merger and acquisition is practicable, but your understanding, because I can we ask you questions. It is 50-50, 50 theory, 50 calculation under what? Merger and acquisition. Now, having explained the definition of merger and acquisition, alternative to acquisition and merger, if I don't want to go into acquisition or merger, I can decide to go into joint venture, expansion of a business. I can decide to do what we call restructuring. It's because of our time. There is another topic called what? Restructuring. And that will take us to what we call restructuring and reorganization, divestment, management buy-in, buy-out, spin-off, and other demergers, right? These are another part of restructuring, right? Because of there's no time, right? But let's see if we can touch that part as well. Now, synergy class. We've talked about advantages, which are the purpose, why you need to, all reasons, right? We talk about the disadvantages. Now, synergy. What is synergy? Synergy is sometimes called 2 plus 2 is equals to 5. Do you know why? If I combine Olanike PLC and and Isaiah PLC together, right? They usually say two heads is better than one, right? Now, what is the effect? The effect is that the combined company is more better than a single company. Class. That is why it is 2 plus 2 equals to 5. Because if you add both of us together, we are better than a separate entity. And what is this synergy? Synergy, right, of the combined company. What is combined, class? What is combined? The acquiring company and the takeover, the target company. Let's say the target company, acquiring company and the target company, combined company, right? Question will tell you, we ask you that what is the synergy when you decide to combine the two companies together? What is the synergy? Benefits, right? Don't forget, when you want to value your business, either you want to merge or you want to acquire, is valuation of a business. And what did you want to achieve? You want to determine the value of the business. Class, you want to determine the value of the business. And don't forget, there are different forms of valuation. Free cash flow is a form of valuation. Economic value added is a form of valuation. Shareholders value analysis is a form of valuation. Methods of valuation is also part of valuation of a business. So when they want to merge, they can decide to use free cash flow to equity or free cash flow to firm. Mostly is free cash flow to firm, because yes, most times it is free cash flow to what? To the firm, because you want to determine the value of the business. Class, mostly it is free cash flow to the firm, but sometimes they may tell you that free cash flow to equity, but mostly in practice you need to determine the free cash flow to the firm, because that is the firm you want to take over, right? And that is combined. What is free cash flow to equity, to the firm of the acquiring company? What is the free cash flow to the firm of the target company? What is the difference? What is the combined? Or you could say, what is the free cash flow to the firm of the target company? What is the free cash flow to the firm of the combined company, both the acquiring company and the target company? Now, if this is the free cash flow to the firm, now what is the difference? What is the benefits? And that will now take us to what we call synergy. We'll get there. Synergy means that when you combine the two together, it is more better. It is more better than what? Than a separate entity. Class, am I communicating?
Yes, sir.
Now, if this is established, we move to the types of synergy, right? We move to what? We move to the types of synergy. That synergy is divided into 3. Synergy is divided into 3. The revenue synergy, the cost synergies, and the financial synergies. I may ask you to explain the 3 types of synergy occur as a result of this scenario, as a result of this merger or acquisition, as a result of AA Limited, that you should explain the synergies that occur. The question is, what is synergy? Means that when you combine the two company, the company profit is better than a single what? A single company. When you combine these two companies together, the profit may rise, right? Now, what is revenue synergy? Revenue synergy means that when you combine two companies together, or following the merger or acquisition, right, it will increase the total sales revenue because as a result of that. And that is what we call revenue synergy. An increase in total sales after what? After merger or acquisition, right? By increasing the total combined market shares. Because if your total sales revenue increases, your market price of the combined company will also increase because you've merged together. Now, let me quickly digress to another thing. I think I saw it, dividend of GTCO, which is GTB Bank. It is actually a time. This is the time of dividend that most investors, those people who feel dividend is okay by then, they are okay with dividend. They receive their dividend, and I think they want to pay about 7 naira. They want to pay about 7 naira something, right? And oh, I want to digress. Okay, no problem. And what is the effect? Now, if a company declared dividend, I'm actually going somewhere, which is efficiency. There is what we call EMH, right? I told you go and read EMH. Efficiency hypothesis market, right? Efficiency hypothesis market. And under efficiency hypothesis market, or let's use under the method of finance, right? Don't forget there is what we call pecking order theory, static trade-off, and market timing. As an investor, you'll be timing the markets. Now that companies declare dividend, what will happen to the share price? That is, you need to look at the technical analysis. What will happen to the market shares? The market price will rise. Class, the market price, because of the actually do what? Declare the dividend. The market price will rise because they don't want people to come into the market and sharply buy so that they will not have access to the what? To the dividend. What will happen to the market price? The market price will do what? Will high, will skyrocket. Then immediately they pay the dividend. What will happen to the market price? The market price will drop because they want people to come into the market. And that is what we call market timing, right? It's still like when you check efficiency market hypothesis, you know what happened in the market actually what affects what affects information. Let's say information, yes, information actually what affects your market price, right? Now, in essence here is that when you combine two companies together, mostly the market price may rise. Now, let's say how. If company A want to merge with company B, let's say company A revenue for the year is 500 million. Company B revenue for the year is 300 million. So as a result of merger, the total revenue becomes what? 800. And that is the benefit of merger. And that is, you can see, that's what we call revenue synergy. Your profit will increase. That is the benefit, the purpose. Because so you're looking at it that when you merge with this, right, your profit, the assumption is that your profit, because before you can say your profit will increase, you will need to look at the financials. The company that you want to take over, look at their financials, right? What are they doing in the past? In the previous year? Now, there is what we call cost synergies. What is cost synergy? Cost synergy means that when cost synergy means that when the combined companies come together, following merger or acquisition, the administrative cost will actually decrease. And that is the assumption that, the cost will actually reduce, right? Cost synergies are reduction in the cost as a consequence of a merger or takeover. Guess what? I have a question on merger on acquisition. I think one of the past questions like that. Question was like, what will be the free cash flow to the firm, right? When they are combining the two companies, when you want to merge the two companies together, which means when you are merging the two companies together, you need to merge the revenue as well as the cost. Now, what is this now? In cost, as consequence of a merger or takeover, you know, either you say you want to merge or you take over. Takeover means acquisition. They might arise because it is possible to improve efficiency. For example, it might be possible to reduce size and cost of administrative departments by combining the administrative function of the two companies. Now, they can actually combine the administrative what function. Class, you will explain all these things. I can may ask you, what are the three types of synergy? Explain the three types of synergy, right? You should know what you to write under the three types. Now, cost synergy. When cost synergy arises, when there is a merger and acquisition, there may not be a redundancy. There may not be a redundancy cost as a result of that, because they are not telling everybody to go. They are just what merging, or they just decide to what to merge as a result of the benefit, right? Now, another thing is financial synergies. What is financial synergy? Financial synergy means that if I merge with company A and company B, and I want to source for a finance, right? I want to source for a finance from the what? From the market. Because of the size, right? The cost of debt may be what? May be low. Because of what? Because of the size. Class. You may get a what? A cheaper what? A cheaper loan, or a cheaper debt, a cheaper loan from the what? From the market. Which means that a large combined company or group may be able to raise finance in a cheaper way, because you are combining two things together. You are combining two companies together, right? As a result of that, you may actually get some loan. Some loan may be actually what? Be cheaper, right? Now, the enlarged company might have access to financial market, of course, and that is it. If, of course, because of your size, I have company A, probably their turnover is just 50 million. Then company B, their turnover is about 35 million. Now, in the financial market, if you want to give, you will give someone who has 35 million revenue or turnover before you can say, okay, this. So, and that is what we call financial synergy. You have access to cheap loan, right? As a result of what? This arises as a result of what? Financial synergy. Class, am I communicating? Okay. Now, if this is established, the larger company might also be seen as a lower credit rate, so that it is able to borrow from banks at a lower rate of interest, right? But guess what? You may, because of what is it called? Can I explain more on cost synergy? How now? Someone can actually do that. Maybe after this thing. Cost synergy, when both of us merge together, it is possible that the administrative cost of the business will reduce. The cost of sales will actually what? Will actually reduce as a result of that, right? Now that is in theory though, right? That is in theory though. It may not even reduce, because you are merging them together. You will still pay the same salary. You still pay the same, although rent may be different, right? Probably you when you merge with A, you move from that side to the other side, right? You may not even pay rent. So it's part of administrative what? Expenses. That's fine. Now, are we still together, please? Don't forget we have revenue synergy, the cost synergy, and the financial synergy. You have access to loan. You can borrow, because of the large company may have access to what? To credits, right? Right? May have access to what? To credits, and this will give what? The lower what? Rate of what? The lower rate of interest, and that is synergy. Don't forget, synergy is divided into three: the revenue synergy, the cost synergy, and the financial synergies. So are we good? Are we good to go? This call will end in 6 minutes. Okay. Class, are we good? Okay. Okay, that's fine. Please, this call will end in 6 minutes. Okay. Okay, before we continue, class, don't forget, I've mentioned that um merger and acquisition, either merger or acquisition, merger or takeover is 50-50. 50-50. Now, 50-50 is that the question will tell you that, oh, if at all merger wants to come as compulsory question, or don't forget, merger is also a form of valuation. Let's say compulsory question. Question is, oh, explain explain the synergies that arise as a result of AA Limited. That is where you will now bring the 3 synergies, right? Calculate the value of equity of AA Limited. They say calculate the value of equity. You should know that this is free cash flow to equity. Or calculate the value of equity. This is free cash flow to equity. Okay, because it's a form of valuation as well. The next one would that be, oh, calculate the value of the combined company. Combined company. Class, combined company. We will get there. I'm just giving you the likely questions under merger and acquisition. The next question could be that, what are the reasons for merger, or what are the disadvantages and advantages and disadvantages of what merger? So you should know all those things, right? Please, you should know it. It's very important. It will give you maybe 5 marks, 6 marks. You move on. Now, why do we have a high failure rate of acquisition, right? Don't forget that in the process of merger and acquisition, in the process of merger, there is always a process. In merger or acquisition, there is always a process, right? There is what? There is always a process. Now, before you can do a bid, before you can bid for, you can take over this, you have to bid, right? And before you can be able to bid, you can be able to bring out your bid price, the takeover company, we need to furnish you with what? Their financial information, the management information, both their financial and non-financial information, because that is what you will use for the bid price, right? Then, when you are done with it, you take it to them that, okay, this is the value of the business. Now, it's not left for the management to say no or yes, that this is not the value of their business, right? That this is not what? The value of their business. And don't forget, there's a regulatory framework that guides what? That guides merger and acquisition, which is Security and Exchange what? Commission. Security and Exchange what? Commission. We'll get there as well. So, this call will end in, okay, 3 minutes. Okay, let me quickly say something here before I create another link. Please, what is it called? Okay, so why reasons for high failure rate of acquisition? Why do we are already in the process, company A want to take over company B, and suddenly, right? And suddenly the other company say, okay, no, we will not acquire this company, or the other company, which is the target company say, no, we don't want to merge, or we don't want to sell our business. Or most times it is always from the um from from the either from the both parties or from one party. Now let's see how it goes. Now, many acquisitions fail and do not provide the value of shareholders that was expected when the acquisition was made, right? That do not provide the value of the shareholders. You present a bid that this is the value of the business. And the other shareholders may say, no, we can't accept this bid, right? As a result of that, acquisition may fail, or the other party, which is acquiring company, may say, oh, there is no any synergy benefit. There is no any synergy benefit. So there is no point. There is no point of the merger or acquisition. Now, the purchase price paid for acquisition is often too low. Can you see it? What you value the business. Probably you undervalue the business. Then, if it is too low, the acquired company, which is the target company, will not what? Will not accept. Or if it is too high, let's say if it is too high, if it is too high, the acquiring company that wants to take over the other company will not do what? Will not buy. With that, acquisition may fail. If the purchase price, please take note, if the purchase price for an acquisition is too high, your value of a business worth 220 million, and you say because of the macro indices, because of this, they overvalue it. Who does that? Acquisition may not what? Occur as a result of this. The expected synergy do not occur, right? How will you know if the expected synergy do not occur? You do your analysis, right? Because those who will form part of the merger and acquisition process are experts, are investment bankers, are experts, right? Investment bankers, they are experts. Look at it. Don't forget that we have some guys that specialize in merger and acquisition. That is their business. That is what they do, right? That is why the world of finance is wide, right? You see some risk management, merger and acquisition. That is what they do. Just merger and acquisition. Now, these expected synergies do not occur. Probably when they calculate the combined company together, then they compare it with what is it called? With the target company. They now see it that there is no benefit here. There is no what? There is no benefit. There will not be any synergy. So there is no point. Synergy means there will be possible increase in your profits, right? When we combine together. Now, another thing is there are serious problems with integrating acquired company into the new group, right? Probably bringing in the acquired company may be difficult, right? And it may actually what? On this, it may actually what? Fail. Employees could cause part of the process, like I said, because even in our offices, when you want to implement something, some will gang up. We say, no, this thing will not work. And it will not work. Right? And it what? It will not work. So it is also occur in what? In acquisition. Employees in the acquired company. What is the acquired company? The target company. Might find it difficult to accept the different culture of the acquiring company. You can see it may fail because employees now, and don't forget, I made one example, not from the north. Let's say, for instance, for the purpose of this discussion, right, from the north, like they may say, no, we can't accept this culture. We can't, right? We can't. And because of that, if you want to force them, they may actually lose key staff. They may do what? They may lose key staff as a result of that. So if the organization is not seeing that, if some of them to lose their major key staffs, it's better for them not to acquire the business, right? It's better for the acquired company. The acquired company will say no because of different culture. So if the acquired company now say, oh, because they will lose their staffs, they are not selling again as a result of that. Right? Don't forget, the synergy do not occur. The purchase price is too high, right? Different culture of the acquiring company, right? Both the acquired and acquiring what? Company. Now, what next? I know it's boring. Class, is it boring? I know now. Hello, unmute your mic.
Not
Nonsense.
at all, not at all. It's an interesting topic.
Okay.
It's better than
That's fine.
calculation.
It's better than calculation. Okay, they play.
It's
They
okay.
play. You go see calculation. They play. Now, in merger and okay, I'll come there. I'll come there. We're moving. So, senior management in the acquiring company. What is acquiring company? The company that want to acquire other business might not give the acquired company sufficient time, right? You that you want to acquire another business, you will not give. So you want to acquire my business, you will not give me time to talk. That means the merger or the acquisition will not occur, right? The senior management in acquiring company may not give sufficient time to the acquired what company, may not give attention to them. Synergy may not occur. The purchase price may too high. 4, the employees in the acquired company may find it difficult to accept the different culture of the acquiring company. That is 5. Make sure you know it too. Now, if this is established, we will move to what? Due diligence. Due diligence. Of course, class, merger and acquisition is interesting. You cannot just come and say you want to buy over this. It is not possible. There is what we call hostile takeover. You want to do rush. You want to force them. It will not work, right? AA Limited want to acquire BB. Then you are coming in hostile force. It's too risky. Why? Because BB Limited will never give you all the information, right? Of course, when there is a process of merger, when they want to merge, I think of recent, right? I think FBN Quest and some FBN Quest are now something. I've forgotten how it works, right? I've forgotten. I know I read something like that. A lot of bidder came in, right? Okay, this is the price, this is the price, this is the price. Let's say one of the bidder now say, let's say for instance, one of the bidder now say, oh no, I must take over this, I must buy it. The acquired company will just be looking at you. They play. If it is your business, come and take over it, right? Come and take over it. That is what we call hostile, right? And that is too risky because the acquired company will never furnish you all the information that you need. So now go and get it. Are we together, class? Now, there is what we call due diligence in merger and acquisition. What is due diligence? Process. Before you say you want to merge, before you say you want to acquire, you need to check the business. Who is the owner of the business? Where is this situated? Who are the major customers? Who are the competitors? Who are these? Who are that? That is what we call due diligence. In real estate that I belong to, right? In real estate, you want to rent a property. So maybe residential or commercial to Mr. A. We will not just give our property like that. You have to pass through due diligence, right? We want to know you. Who are your guarantors? Where did you live? Who are this? Who are that? Excuse me. Right? Sorry, a minute, please. Sorry. So we will not just give you the property, right? Because we need to assess you. We need to know you, right? So once we meet up with the threshold, so you are good. So the same thing applicable to what? Merger and acquisition. Now, there are two types of due diligence. There are two types of what? Due diligence. One, there is financial due diligence. What is financial due diligence? You have to check their financial statements. You do what? You check the financial statements, analyze the financial statements, check their major debtors, right? Check their major creditors, right? What are the sources of finance? Are they using their bank overdraft to purchase more assets, or they are using their long-term loan to purchase more assets? How did they finance the business? Who and who gave them money? At what rate? Class, am I communicating? There are two types of due diligence. One, financial due diligence, legal due diligence. The financial due diligence is for you to analyze the company statement of financial position to know who are the debtors, who are the creditors, where did they borrow the loan from? Are they using their overdraft to do what? To purchase more assets, or they are using their what? Their long-term loan to purchase more assets. What is their available cash at the end of the period? So these are the due diligence you need to do, right? These are the due diligence. When you want to acquire or you want to buy over a company, you need to do what? A proper what we call a proper due diligence. The legal part of it is that, are they owing? What are the legal issues, right? Are they complying with the relevant laws? Did they have any legal issue with Federal Inland Revenue Service or the State Inland Revenue Services? Or did they have any court case, right? That could stop the acquisition process. Class, am I communicating? Class, am I communicating? So you need to know all this in merger and acquisition. You need to do what we call due diligence. Do what? Due diligence. Where we have the financial due diligence as well as the legal due diligence. Now, if this is established, let me quickly explain finally, right? OSI takeover. I've been explaining it that it may be difficult to do that because the acquired company will not furnish you all information that you will need, right? That you will need to quote the purchase price for that business, right? And that is it. So class, I hope I've been able to communicate at least what other things you need to know. I think that's all now for now. So maybe when we move, we'll talk more. Yes, I think that's all. That's all on the theory. So any other question? Okay, I see any other question. Any question, please? Question. Question time. Sincerely, I don't have, oh, shit. These notes, I just prepared it about 10 minutes ago. I think before I entered the class, I think about 20 minutes to the class. That is when I just decided to look for one or two things together. All these things, it's not that I've been reading it from since morning. No, just 20 minutes. I just have to put all these right up together. So I don't have what is it called? Questions.
Please,
Um,
could you please explain little more about this due diligence? I don't really get how it works. Sorry.
okay, please, can someone explain due diligence? Please, maybe someone should assist us with that.
Hello.
Hello, yeah, I'm with you.
Okay. from what you explained, due diligence should be part of the processes of an acquisition or mergers, whereby the acquirer takes a due diligence on the target, and there are two ways by which this due diligence can be effected: the financial due diligence and the legal due diligence. On the financial due diligence, the acquiring company has to look at the financials of the target company. That's their statement of financial positions and the rest, to see, okay, who are their major creditors, their major debtors, their sources of finance, and maybe their level of profitability and what have you. And the legal part is that hope the target doesn't have any pending court case that might forestall the process of the, what's it called now, the acquisition process, or if they have any pending court issues and whatever, anything legal that could, be an issue in the future. So that's the acquirer has to make sure that they know about all these things.
That's a very good one. Ah, that's a very good one. Um, you deserve something now, I suppose. Exclusive. Sure, I suppose compensate you now, right? But I don't have cash. I don't have cash. Wetin my- wetin I- Okay, that's fine. That's fine. That is a very that is a very good one, right? That's a very good explanation. Well done. Well done. Okay. What says the time? This is 9:54. I think I've been able to explain this. 9:54. 9:54. You don't have the question. Okay, let's check. Let's check this question together. May 2019. Quickly, someone should send it to the platform. May 2019. Quickly. May 2019. Paco. May 2019. Quickly. Go tomorrow. The notes. No. The note is not. I didn't arrange it well the way I want it to be. It just a rush something. Let me work on the notes. Let me just work on it. I didn't work on it too well. I just copy it for somewhere and start the explanation. You get. So I need to work on it. Or should we continue tomorrow? We'll just go straight to calculation. Class, hello, hello. Okay. Please, someone should send the May 2019 quickly. Let's check. I'm still waiting, please. May 2019. Oh, May 2019. Coming, you need to check. No, I need the full PDF so that I can't see this one. This one is not, it's not that clear now. Favor, it's not clear. It's not clear. Can send the full question.
Marco PLC will soon announce.
No. What is the policy? No. What is our
Okay,
policy?
requirement first. Okay,
Yes,
requirement
you need to
first.
understand what we want to do. Thank you. Okay.
Okay, requirement first.
Yeah.
Okay, requirements A. Estimate how much synergy is expected to be created from the takeover using free cash flow to the firm analysis for each individual company and the potential combined company. State clearly any assumption that you make. Note.
Thank you.
The weight.
Okay. Go ahead.
Okay, note. The weighted average cost of capital of the combined company is assumed to be 9%.
Thank you.
B.
Now,
Okay.
class. Interesting. Using estimate how much synergy is expected to be created from the takeover, right? What is the benefit? Will my profit increase as a result of takeover? And if I want to use that, I have to use free cash flow to the firm. That is why I said most time you will use free cash flow to the firm. Analysis for each individual company. Individual company means that you have to check, you have to use free cash flow to the firm for the acquired company and acquiring company and the potential combined. Then you will not combine them together. Then you will now compare. If I combine these two together and one of them, am I going to make a profit? Will my profit increase or not? Then for the combined company, you use 9% given to us. It is assumed to be what? When you want to discount the combined company, which is both the acquired and acquiring company, you use 9% to discount them. Then for individual, you need to calculate the weighted average cost of capital for each of the individual, which is what? For each individual company, which is the acquiring company and the acquired company. This is 20 marks. 20 marks. Now, discuss. Okay, go ahead, please.
Question B. Discuss any 5 limitations of the above estimates.
Thank you. What are the limitations? What are the possible limitations you may face as a result of the above estimates? Right? You can take it back to some of these disadvantages, right? Some of these disadvantages of it, because what is the assurance that the cost will reduce? What is the assurance that the revenue will increase? What is the assurance, right? The limitation of what you did, because it is an estimation. That's why they say estimate. You are projecting for the future, right? It may not be realistic. It may not be accurate. Let me just use that word. It may not be what? It may not be accurate, right? We'll get there. Next.
The question C, explain generally 3 advantages and 2 disadvantages of expansion through merger and acquisition rather than through organic growth.
Thank you. Through organic growth. What is organic growth, class? That is through internal development. If I don't want to use internal development rather than organic growth means that through internal development. If I want to expand my business, if I want alternative, let's say alternative to merger and acquisition. If I don't want to merge or acquire any other business, I could use I can use alternative acquisition, which is organic, right? It could be through expansion. I can decide that, okay, I want to do joint venture. I can decide to use what we call restructuring, right? Now, that is that. They are telling you that what is the advantages and disadvantages of expansion to other than the other. So list 3 advantages and 2 disadvantages of what? Merger and acquisition, and it is what? 30 marks. Thank you. Next. We are done with this, okay? Please go ahead.
Okay. Paco PLC will soon announce a takeover bid for Ronke Tina RT PLC.
Thank you. So takeover. So Paco want to take over Ronke. Paco want to take over Ronke. Abi will soon announce itself. So which means that Paco is the acquiring company. Then the acquired company is the Ronke Tina, which is RT. Okay, go ahead, please.
Okay. A company in the same industry. The initial bid will be an all-share bid of 4 Paco shares for every 5 RT PLC.
Thank you. Now, this is another interesting. This is another aspect of merger and acquisition, right? Which is share to share. I can decide to use share to shares. Let's use share to share. How many shares do you have? Yeah, give me your own shares, okay? Let's exchange. Share to share exchange. We will get there. Now, the question now is the initial bid will be an all share bid. The initial bid before now is all share bid. Before now, it is all share bid of 4 Paco shares for every 5. For every 5. For every 5 of RT shares. That is the initial what? Initial bid. Is that not so? So Paco will give 4 for every shares in what? 5 in what? In RT. That is initial bid. Now the bid has actually changed now. That is why they say calculate the free cash flow to the firm of each what? Each company and the what? And the combined company. Next. The most
recent annual data relating to the 2 companies are shown below.
okay.
Sales revenue. Okay.
I need to
Can I go on?
No, so sorry. I'm coming. Okay. Please go ahead.
Yeah. Sales revenue, operating costs, tax and liable depreciation, earnings before interest and tax, net interest.
Okay. Just hold on. Sorry. Thank you. All figures remain the same, right? Now, can you see the other information?
Yes, I can see it.
Okay. Then that's fine. Thank you. Annual replacements. This question is tricky, right? Now, annual, don't forget, the required says that free cash flow to the firm or for each individual, right? And the potential combined. Now, which means we are calculating free cash flow to the firm for each of the what? Of the firm. Annual replacement capital expenditure is what? 1,600, 1,240. And what will happen to it? Expected annual growth rate in sales, operating costs, including depreciation, replacement investment, and dividend for the next 4 years are 5% and 6.5%. Class, are we still together? Hello? Okay.
Please, we are exhausted.
Interesting. Okay. Mawusungo, just okay. Now, expected annual growth rate in sales, operating costs, including depreciation, replacement investment, and dividend for the next 4 years, which means that the growth in sales, operating costs including depreciation, replacement investment, and dividend for the next 4 years, the growth rate, class, the growth rate is 5% and 6.5%. Class, the growth rate is what? 5% and 6.5%. Now the question is, how many years? How many years? We don't know, but okay, they say in the next what? 4 years. Okay, in the next 4 years. Can you see it? It's always stated anywhere that, oh, we should calculate the free cash flow for 2025, 2026, 2027, 2028 to 4 years. Now they say in the next 4 years. This is to tell you that your annual replacement capital expenditure will increase by 5% for PACO, 6.5% for what? RT, for 4 years. Not only that, your sales revenue will also increase. Your operating cost will also increase with the same what? With the same 5%. That is what it means. Expected annual growth rate in sales, operating costs, including depreciation, replacement, investment, and dividend after 4 years. Interesting. Interesting. Now, the first one is for the next 4 years. The second is after 4 years. That is infinity, class. That is what? Infinity. Class. So this is to tell you that when you are done with the replacements of, you increase the sales, you increase the replacements, the sales, the operating costs include depreciation, increase it by 5%, you increase it by 6%. At the end, when you calculate your free cash flow to the firm, there would be thereafter. Thereafter. That is why they say dividend after 4 years. After 4 years. That is to infinity. Class, am I communicating, please? Hello? No. Now, if this is established, class, the gearing long-term debt slash long-term debt plus equity. So which means there is debt divided by debt plus equity. Right? 30%, 55%. For PACO, debt will be 30. Debt will be 30 again. Then equity will be what? Will be 70. Don't forget. Your denominator must be 100. Is that not so? Under the risk-adjusted cost of capital, we've done something like this before. Your debt is 30. Your equity is 70. Right? That is why you will now have 30 divided by 30 plus 70 under PACO. Still, you do the same thing for RT. The market price, right? That is the market price per share. Then the numbers of shares issued. Then, what again? I'm coming. The current what? Current market cost before tax of fixed interest debt. Okay. Of fixed what? Interest debt. Current market cost before tax of fixed interest debt. So this is debt rate, right? This is what? The cost of debt. And it is what? Before tax. It is what? It is before tax. Equity beta, don't forget. When an equity beta is greater than 1, what is the implication? When it is less than 1, what is the implication? What is systematic and non-systematic risk, class? Don't forget. I saw a question on that. 2 marks. Imagine you define systematics 2 marks with example. You define all systematics 2 marks with example. Right? Then the next question, portfolio. Right? Now, we'll do that in our revision class, right? Risk-free, 4%. Market return, 11%. This question is very simple. But you have to unlock some things. And what are you going to unlock is these things given to us. So we increase our sales, right? Sales replacement by 5%, 6.5%. Then when you are done with your free cash flow to equity, you do your thereafter, which is the infinity. You increase by 4% and 5%. Don't forget, you need to calculate the weighted, since it is free cash flow to the firm, you need to calculate the weighted average cost of capital for each of the company, right? Now, the takeover, finally, before we go, right, I needed to analyze this question because we need to understand how it works, right? The takeover is expected to result in cost savings in advertising and distribution. So when there will be, if Paco take over RT, there will be a what? There will be a cost savings. And this is one of the advantages of what? Merger or acquisition. Cost savings. Right? The takeover is expected to result in cost savings in advertising and distribution, reducing the operating cost, including depreciation of Paco, from 76% of sales to 70% of sales. We'll get there. That is when you want to determine the combined company, which means that when you combine the two companies together, after the takeover, the operational cost will reduce to 70% of the sales. The growth rate of the combined company is expected to be 6% to 4 years. So when you want to combine the two companies, you add the revenue of Paco and the revenue of RT. Then you increase it by 6%. We'll get there. And 5% thereafter. So when you prepare the free cash flow to the firm, thereafter, you cannot do the infinity. RT debt obligation will be taken over by Paco. The corporate tax rate is expected to be 30%, right? Distinguished professional colleagues, this is one of the compulsory questions, right? Now, there is another question in merger or acquisition, which is share-to-share exchange, right? You need to have the knowledge of IAS 33. We'll get there. So, I think we need to go now, right? This is 10:24. Interesting. Please, question before we go. This is just analysis of the question, right? Tomorrow we'll start early so that we'll make sure we complete this question tomorrow. Please complete this question tomorrow, then we'll move ahead again. So, question, please. You say amen. Okay. So, question. Rachel, are you still with us or against us? Gifted.
Yeah, together, sir.
Okay. That's fine. Gifted. Okay. Okay. So there's no question, right? So we have to go, right? So thank you so much, everyone, for joining. For those who are here to pay for the pre-scene analysis, right? It might interest you to know that about 30, more than 30 students are actually paid for the pre-scene, right? The thing is that it is the students are to complete 3 tasks before the pre-scene analysis, right? They are to complete 3 tasks. And guess what? Once they are done with that 3 tasks, once the pre-scene is out, they can start their answer plans, the cover page, and some part of executive summary, right? Because we will make sure we do the needful. That is what we do at Next Gen Professional Associates. Analysis, right? Is analysis. So if you are here to pay for your pre-scene analysis, please, right? We have a limited slot because I had a discussion with one of our stakeholders, right? We have a specific target, right? So please, we want you to benefit from this case study analysis of a thing, right? Because it is not difficult. It's just for you to get the right person to tell you, okay, this is the simple way of writing report. Guess what? The reporting style I'm using in my current place of work, right? I actually copy that from where the person that actually taught me case study, right? Case study. So I just needed to do what? To modify it to suit the current operation. And that is what you can do. You can use the report anywhere, any day, either internal control or analysis or audit or tax, right? You can as well use it. So thank you so much everyone for joining. Enjoy the rest of your evening, right? Don't enjoy the rest of your evening because no sleep for the wicked. Thank you. You see those Yoruba